Good evening, everybody. My name is Wenner. I'm the CEO of DLP Capital Advisors. I know a few are still getting their dinner, but I'm going to go ahead and get it started. So I'm going to tell you a little bit here tonight about us, DLP, about our investment strategies, what we do, and how we do it. Before I do that, I want to acknowledge our existing investors who, a few are here with us tonight, some are watching us online, and some will be watching this recording, I'm sure, in a couple of days. So everything I'm about to show you guys that we do, the thousands of apartments we own, the properties, loans, all the employees we have, is because of the investors we have. So we have an amazing group, as you can see here, of 221 investors. Many who've been with us for 3+ years, 5, 6, 7 years. Many investors have been with us for less than a year. As we are bringing in about 15 to 20 new investors joining us each and every month. And hopefully we'll be welcoming some of you to the DLP family here in the upcoming weeks. So, the way we look at investing, we try to make things a little bit, try to simplify things. So, if you're looking through our brochures, or you've been hearing us on the radio, or looking at our website, it can kind of seem like we got a lot of things going on. It can seem a bit overwhelming. Trying to make sense of all the things we do. And a lot of investing can feel that way. So we're trying to make this presentation a little bit simple and focus on two things, what we believe to be the two keys to investment decisions. Number one is the manager, who you're investing in. Number two is the strategy. So what is the business plan and how are they executing the investment strategy? So I'm going to start with talking about the management team. So as you see on screen, it says leadership is kind of a big deal. So I'm going to tell you a little bit about our leadership team. First, a little bit about myself. I've been in real estate now for 11 years. I live here in the neighborhood in Valencia, actually literally right behind me, with my wife and 2 boys who are 4 and 5. My oldest actually starts school at Valencia here in August. I've closed over 5,500 real estate transactions. I own over 400 properties, and I'm the CEO and founder of our family of companies you're going to hear more about in a moment. This is the rest of our leadership team, and a little bit off the screen there, but you'll see we have an incredible leadership team here. Bob Peterson, our CFO, Barry DeGroats, our general counsel. They're also both partners in DLP Capital Advisors, and this is our capital management firm. We have a brand new chief operating officer who officially starts with us on Tuesday, which we're really excited about, named Maureen. Leaders in property management, construction, investments, marketing, and sales. So we have a leadership team of about 11 executives. And then here at DLP Capital Advisors, our management team, some of the same people, plus people like Larry Hickerdale, who's in the back, one of our investor success managers. Probably the most important people to you are our fund accountants. They're the ones who make sure you get paid each and every month, and make sure your distributions go out. Mandy, who's hosting and putting these events together in the back where everybody met when you got. And a few of our other team members are here. Jean, who's our commercial sales extraordinaire, and Bert, who used to actually own a bank here in Jacksonville, and is one of our funding specialists growing our lending business you're going to hear more about. So please take the opportunity after we get finished, or if you happen to be sitting at the table, with them to chat with them and hear about their story and their role at DLP. This is the family of companies that we own and manage. So 5 main companies, which you're going to hear more about in a second, and then some affiliated or sister companies that support our main businesses. So how everything works together here, I know it's a little hard to read probably in the back, and keep in mind most of what you're going to see here, a good amount of it, is in those brochures as well. So DLP Capital Advisors, what you'll see at the top here, that's the investment management side of our company. That's where you would invest into, and that money is what we utilize to invest into the strategies you're going to hear about. Direct Lending Partner is our lending company. So we lend money to real estate investors. DLP Acquisitions is our acquisition side of our business. We're predominantly buying apartment complexes, 50 to 300 unit apartment communities. DLP Builders is our construction company. DLP Property Management company, and DLP Realty is our real estate brokerage. So how did we get started? It's a question we get a lot. Been with us now about 11 years. A lot of people, looks like we've done a lot of things pretty quickly. I got started, I should say, as a real estate agent 11 years ago. For pretty much immediately began flipping houses, just like you see on HGTV, buying distressed homes, renovating them, and reselling them. So in the very beginning, how investors like you started working with us is you would lend us money, and we would pay you an 8 to 10% fixed return on your money, loans to go out and flip these houses. So we did that for quite a few years, and we expanded pretty quickly to buying 30 to 50 houses a year. We were buying 3, 4, 5 houses a month by about our third year in the business. Then we started growing. We flipped about 300 homes by 2010, and then the market was finally at its bottom, if you remember that. Felt like it was never going to stop dropping, and then we finally hit the bottom. When we hit the bottom of the market in 2010, we said, all right, this is the time to build a rental portfolio. This is the time to buy. The bottom of the market, prices are only going to go up. Let's start building a rental portfolio. That led us to launching these investment funds that you're going to hear about tonight. So we started needing a lot more capital, because before we were flipping our houses, we kept turning the capital over again and again. And then we started buying rental properties, houses, apartment communities, commercial office buildings. We started needing more capital. So we launched our first investment fund called the DLP Equity Fund I. And that fund was focused on going out and buying single-family homes, some apartment buildings, improving them, and holding on to them through the upcycle of the market. And we're starting to sell those properties actually right now. Then we launched our second fund, which is called the DLP Fixed Fund, which was focused on doing what we started doing, which was providing investors with a way that you could earn a fixed return on your money. So 7 to 10% fixed notes, which is what we still do here today. So if you've heard about our fixed notes, fixed returns, that's what this product is. How we started was what was called the DLP Fixed Fund II. So as we continue to grow, we now have purchased 700, 800 single-family homes by 2012, 2013. We had a large property management company, large construction company to support all of our buying of these single-family homes. We started realizing we needed a way to scale. So buying single-family homes scattered all over the place is a challenging business to grow. At one point we had about 40 houses being renovated at every minute of every day. We had about 80 to 90 full-time guys in our construction company as full-time employees, and we would have about 200 subs on our jobs. So we had 250 to 300 people out in the field on 35, 40 houses, renovating them, working on them each and every day. We said, well, we kept having more and more investors wanting to invest money with us, and it was, how do we grow? We can't really get 10 times bigger. You lose scale, it becomes less profitable. How do we get bigger? How do we scale? So we decided to focus on two things. Number one was we said, well, we've really mastered this flipping houses. We really understand it. We have relationships with contractors. We really understand the market and values and how to do this really well. Let's go out there and help other investors do this. And we can really scale our business. So we launched the DLP Lending Fund, which was our launch into actually lending money to other real estate investors. So we lend money to other investors who are buying houses, renovating them, and either flipping them or turning them into rentals. So we provide them with all the infrastructure, knowledge, resources, relationships, and money that they need to go out there and buy houses. We also said, well, we have all this knowledge, we have all these great property managers and leasing agents and maintenance techs, and how do we scale that business? How do we scale this managing of tenants, managing of properties? And we realized very quickly that going after larger apartment communities would allow us to scale and get a lot more systemization in our business, be able to deploy a lot more money. So we really started focusing on buying 50 unit, 100 unit, 200 unit apartment complexes. We started all of this in Pennsylvania and New Jersey, you're going to hear more about, and then we expanded it here into Florida and now throughout really the entire Southeast, which you'll see in a moment. So to recap, from 2007 to 2014, we flipped over 500 homes. We purchased over 800 homes, apartment complexes, commercial office buildings. We grew to the #1 largest real estate team in brokerage in Pennsylvania. We continue to grow that business each year. #8 in the U.S. We grew DLP Builders into one of the largest regional home builders and construction companies. Grew our property management company, and so forth. So fast forwarding from 2014 to 2016, we grew most of our business by over 1,000%. We grew and multiplied and expanded geographically. Continued this path that we're on here today. So to fast forward here to where we are right now, we've now been managing capital for about 10 years. this is where it's really important to everybody in this room. 100% of every month that we've been in business, so going on now, 120 months or so, we've paid out our fixed returns for our investors each and every month. We've never missed a fixed return. Some of our investment opportunities, the equity offerings, the Income and Growth Fund, the Equity Fund II, the DLP Lending Fund, you're investing as a limited partner. Those funds don't provide a fixed return, but they provide a preferred return, meaning you earn a certain return before we earn anything. We've never missed a preferred return on a singular month. We've had zero principal losses to any investors in any of our funds or any of our deals. We manage 5 active real estate funds right now. All of our funds are open and operational that we started opening years back, starting with the Equity Fund I. We own over $220 million in assets, which is over 400 properties and 200 loans, which you're going to see more about that in a second. We employ 165 employees. Actually, now it's about 175 across 6 states. We're one of the 5,000 fastest growing companies in America for 5 straight years. Which is really, really important to us. So to make that list, that means you had to grow pretty fast over a 3-year period. Less than 2% of companies make that list the 2nd year in a row, meaning they sustain that level of growth. It's well under 1/10 that make it the 3rd year in a row, and so forth. It's very rare to continue to sustain a consistent level of growth, which is what we're about, is consistent, steady growth. We invest throughout Pennsylvania, New Jersey, Florida, Georgia, North Carolina, and South Carolina. And we lend capital throughout the East Coast. So where we're heading from here, why we invited you all out here tonight and provided everybody with dinner and drinks, is because we're still growing. So despite the success over the last 10, 11 years, we're just getting started. So as I mentioned a moment ago, we have $220 million in assets. That means we own $220 million worth of real estate and real estate-backed loans. We plan on by 2025, which might sound like a long time from now, but that's about 8 years from now, having $1 billion in real estate holdings and $1 billion in loans, so $2 billion in assets. So basically growing about 1,000% from where we're at today. By 2030, we intend to have over $1 billion in investor capital in our funds. So that's the growth pattern we're on, and that's why we've invited everybody here tonight. So what drives us? We have 8 core values that drive us, that we live by. We didn't just come up with these because they look good in brochures, which they do, but also because it's what we live by. So I won't go through them all in detail, but you can read those in your brochures. It's really important to how we operate. Investors initially get interested with us because of the returns, but they stay with us and they ultimately invest because of the values, the way we treat our investors, the communication, the transparency to what we do. So what a lot of people are thinking by the time we get to this point in a presentation or hearing about it so far is this too good to be true? This is actually a great deal, this is actually a great opportunity, or is this too good to be true? So to start helping you understand and realize this is real, these returns are real, we're doing this right here, right now in this market. We got approval about 1.5 years ago now by almost all the major brokerage custodial platforms. So investors can invest right through Charles Schwab, Fidelity, T. Rowe Price, etc. That was a lengthy process, due diligence process to get approved, to pass the test of all these major brokerage custodial platforms. We have third-party financial audits of our funds. Our 2016 audits are literally being finished right now. We're just waiting on a few investors to sign these forms called confirmations, and our audits will be wrapped up, and they'll all be available to you on our portal, which if any of you don't have access to that yet, we'll provide that with you here tonight. And we're an approved investment option for a number of registered investment advisory firms who actually refer their clients to us, who hold themselves to a fiduciary responsibility, have to go through legal counsel and so forth to actually refer their investors and oversee their investments with us. So another quick point I want to make about our investment opportunities: you can actually invest right through your IRAs. You can do that through your major broker custodial platforms like Charles Schwab or Fidelity, as well as through self-directed IRA platforms as well. So you can actually invest qualified money. A lot of investors can invest depending on how your 401k is set up. You can actually invest 401k funds with us as well. We're endorsed by some pretty big personalities here locally. Rich Jones, that's how many of you heard about us on the radio. Nationally, guys like Sean Hannity, Barbara Corcoran, Glenn Beck, etc. So where do we do all of this that I'm talking about? Right here in Florida. I live here in St. Augustine. We invest in Jacksonville, Orlando, Daytona Beach, etc., which you're going to see in a moment. So this is the best way to show you where we invest. It's a little hard to see in the back, But on the left here, it tells you how many properties and loans we have in each state. And we're starting to fill out the middle of the country here over the past year, the middle of the East Coast, I should say. But we have 45 properties, 38 loans here in Florida, a few throughout the Carolinas and Georgia, and a lot still in Pennsylvania and New Jersey. Here they are kind of mapped out by geo-tracking. So you can see here in Florida, they're all throughout, but a lot right here in Northeast and Central Florida. Overall, about 50% of our capital is in Pennsylvania, 26% in Florida, 9% in Georgia, 8% in New Jersey, and then 3% in each of the Carolinas. So now I'm going to talk to you about the strategies, the opportunities, and the returns. So one of my favorite quotes on investing is from Warren Buffett. When he was asked by Tony Robbins how he became so wealthy, he said 3 things. Number 1, living in America for great opportunities. Number 2, having great genes so I live long. And number 3 is compound interest. So we're a big believer in compounding returns, consistent returns. Another great man once said, the best way to make money is not to lose money. So generating consistent returns month in and month out is the key to building wealth. So often the world of investing can feel a bit like this. I'm not sure which way to go. You hear lots of different opportunities. It seems a bit confusing. We're going to try to make it simple here and break down what we do into 2 different strategies. The first strategy, the first thing we do is we buy income-producing real estate. So we buy real estate that produces consistent monthly income. Predominantly, we're buying 60-unit to 300-unit apartment communities. Now, we're buying what are called B and C class apartment communities. Anybody know what a B and a C class apartment community is? Okay. Few. Ginny, I hope. Yes. So B and C class means they're not the brand new communities with clubhouses and brand new fitness centers and elevators and so forth. They're typically apartment communities built in the 40s, 50s, 60s, 70s, 80s in safe neighborhoods, but they're not considered luxury. So everything that's being built right now, so anybody here who lives in Jacksonville, around Jacksonville, you see all these beautiful apartment communities being built. Those are all Class A. The average rent for a 1-bedroom in most of these communities is $1,600 to $1,800 a month. Our average rent on a 1-bedroom is $600 to $800 a month. So affordable housing in good neighborhoods where they're not making any more of this product. So we utilize our in-house property management company to maximize the value and the cash flow. We focus on generating double-digit returns on each property we buy from cash flow while increasing the value and benefiting from depreciation and tax benefits. So why B and C class multifamily? Well, apartments as a whole, many of you might know, homeownership is on the decline. It's been on the decline since 2006, 2007. Many believe from a macro standpoint that's going to continue. The average age now that somebody gets married is 37 years old. The average age now that people buy their first house is 38 years old. Both are the oldest ever. In addition, as most of us know, we're in a more transient society than we used to. People don't stay at the same job forever. If you stay 5 years, that's a long time anymore. And people like the flexibility of being able to move to different places. That's one of the great benefits of being here in Florida. Now that more people have choices, they choose warm weather, of course. So people are choosing rentership. Homeownership is declining, and there's no new supply of what we built or what we own. So since 2011, there has not been one single B or C class apartment community built in America. Not one. There's been more apartments built since 2011 than houses, but they're all Class A, meaning they're all high-end rentals. There's nothing that's being built that's affordable, which we have a huge need for affordable housing in America. Income growth is not keeping up with rent growth, home price growth, etc. There's a big need for housing, affordable housing. And we believe because of that huge demand for this product, no new supply, that in a recession, which we will go into another one again, that we're going to be able to maintain very strong occupancy and generate great cash flow throughout all economic time. In Florida here, as an example, there's certainly exceptions, but as a whole, home prices went down 40, 50, 60, 70% from the top of the market to the bottom, as many of you know. Rent stayed the same. On average, there are certainly pockets, but on average, rent didn't go down. So it's going to be, even when we go into this next recession, when home prices start going down, even if there's too much supply, even if there's too many brand new apartments being built, there's no affordable housing being built. So why invest in this strategy versus our other strategies? This strategy has the highest targeted returns of 17% annual net return to investors, which you're going to see more about that in a second. So 17% annualized net to you. Long-term wealth creation is a key to this fund. This is a longer-term fund. You go into this fund if you're looking out at the next 8 to 10 years. Tax shelter benefits, you're going to be able to shelter or defer most of the income we pay to you through depreciation, which we'll hear more about in a second. You're able to be a passive partner, so be very clear. We're not here to sell any of you guys to go out there and buy apartment complexes. You're investing passively in a fund that will own thousands of apartments. We handle all the management, we assess all the deals, do all the legwork, handle all the operations. We're out there buying distressed deals. So you see here as a great sign of the type of deals we like to buy. Must sell, lost job, can't pay mortgage, wife left, took dog, house is a gem except for the asbestos. That's all. So in a funny way, that's what we look for. We look for distress. We look for opportunities where it's been poor management, they ran out of money and they couldn't maintain the apartments. Those types of issues where we can come in there and bring in capital, operational strength, management strength, and really improve the value. We provide excellent management, friendly faces, an environment that people want to live that's safe and enjoyable so that tenants want to stay. So we have a great team. You saw some of them earlier here. We hear some of the key people who support our property management. We have about 55, 60 employees in our property management side of our business. We do a lot of very unique things. Example is we sign 2-year leases instead of typical 1-year leases. We focus on keeping tenants and have a tenant retention program. We sign them on to 2-year extensions. We have an elite preferred tenant program. We give them a lot of unique benefits. We have a way where you can get double your security deposit back if you leave the house perfect. We do a lot of very unique things to keep tenants and also keep our properties well maintained. Some of the other resources is our real estate brokerage. As I said before, based on last year's ratings, we were the #8 real estate team in America. The new report comes out next month. We'll be in the top 5 in the country, we expect. So we understand the market, we understand, and we have the ability to sell properties. DLP Builders, we have large construction company ability to assess these properties, handle large capital improvement projects, improve the apartment. Lots of we're coming in, as you'll see in a moment, and fully renovating these apartments. We have great maintenance team, technology, and due to our size, we get great volume discounts. We focus on delivering value to our tenants. Here's the first, if anybody's heard about the Equity Fund 1 or 2 before, you probably have not heard of this. This is our first acquisition. We close on this property on Thursday, so on June 1st. This will be the first property that this fund is going to own. This is a new fund we opened in late March. So this is a 96-unit apartment community, a 2-story apartment community in Titusville, Florida. They're 1- and 2-bedroom apartments, all with private entrances. There's a pool about 2 miles from the beach. This is our second acquisition going into the fund. It's 196 apartments in Warner Robins, Georgia. It's actually 3 communities, 2 that are right next to each other, 1 that's about 2 miles away. They're studio, 1-bedroom, 2-bedroom, and 3-bedroom apartments. One of the apartment communities, the one in this picture, is what's called a cardinal community, which you're going to hear more about in a moment. This is one of the other communities right next door, and this is the third one. 2 of them are single-story apartment communities. 1 is a 2-story community. We close on that property the first week of July. So by the first week of July, we'll own just under 300 apartments in this fund. Here's some other examples of some of the other communities we own. This is a 128-unit community we own in Greensboro, North Carolina. So see, this looks a lot like the one that I showed a moment ago, just like this one, which is 64 units in Jessup, Georgia. These are all cardinal communities. They're these communities that were built in the 70s and 80s that are all built exactly the same. They're all single-story. Most of the buildings only have 6 tenants, so most people only have 1 neighbor. You have private patio. You have a lot of space. They're spread out over 64 units. Will be spread out over 8 acres. People love them. You attract an older crowd that stays a lot longer. Quiet. Great apartments. We love them. You keep tenants on average for 6, 7, 8 years. Generate great returns. They're easy to maintain. They're easy for us to systematize. So we own a number of these communities. Here's another one we own here in Jacksonville. This was the first one we bought, 64-unit community in Jacksonville. This is a community we own in Daytona Beach, a 56-unit, 2-story community. So we often come into these communities and we completely demo and put new kitchens, new bathrooms. Here's an example of what one of these Cardinal apartments look like when we buy them. They pretty much all look the same. Wallpaper, exhaust issues, old kitchens, exterior neglect, pretty rough shape. We come in there and put in new kitchens, all new hard surface flooring in the living areas, usually throughout, sometimes carpet in the bedrooms, all new lighting, really make this place nice. And people then are renting an apartment like this for $700 a month in a safe neighborhood. So here's the overview on the fund. It's an 8 to 10 year investment commitment. You can get out sooner if you need to, with 120-day notice, but you don't go into this fund unless you're planning to be in it long term. We're going to be taking in investments from right now. We started the 3rd week of March, to likely about this time, maybe a little bit earlier than this time next year. So it'll be open for about a year for investors to come into this fund. We're going to end up owning about 3,000 to 4,000 apartments in this fund. We will take in a maximum of $40 million of investor money, and we'll leverage that money with bank financing to own about $100 million worth of apartments, which will be 3,000 to 4,000 apartments. Now, this fund will produce a 7% preferred return, which means you earn 7% before we earn anything. We will send out distributions on a quarterly basis with a goal of distributing out 8 to 9% annual returns on a quarterly basis, which in simple terms means we're going to distribute you about 2% of what you invest each quarter in income that we generate from renting out the apartments. Now, most of that income is going to be deferred from tax due to depreciation. I mean, you're not going to pay tax on it this year and actually you won't until the fund winds down. Then you'll be taxed at long-term capital gains. The overall return goal is 17%. So that's the 8-9% we pay you each year. And then when we sell the properties off, the return that you receive from the appreciation, the principal pay down, and so forth. So 17% plus annual returns net to you, which in short term means you're going to earn 8 to 9% each year. And then in the 7th, 8th, 9th year of the fund, you'll get 2 to 2.5 times your initial investment back. So, alternative is, top is you're watching tennis match, bottom watching the stock market. This fund is about generating consistent returns. Our second strategy, that's strategy 1, buying apartment complexes. Strategy 2 is making loans to real estate investors. So I want to start off being very clear. We don't make loans to homeowners. We're making loans only to real estate investors, predominantly professional, experienced real estate investors. We do not have to deal with banking regulations. We're able to move very quickly. It's a great opportunity. Houses are always in need of renovation. We're an aging housing population right now. I mean, homes continue to get older and need to be renovated. This is a very, very hot market right now, but it's always a great business, lending short-term private capital to real estate investors. Most of our loans are 6 months in duration. All of our loans are first position loans, meaning we're securing a first position mortgage against the house. On average, we're at 57% loan to value at first position. On average, we're at 73% loan to cost. What that means is the investor puts in a lot of their own money, 27% on average. So let me ask you guys a question. Anybody surprised when I tell you that in the downturn of the market, there were about 10 million foreclosures in America? Right? Most of us knew, they might not know it was 10 million, but we knew there were millions of them, right? But let's take a guess at how many of those 10 million the borrower put down 20%. 0.1%. Yeah, it was under 10,000. It was less than 0.01%. A minuscule percentage. When people put their money into a house, whether it's an investment or their personal home, they make the payments. When they don't put money down, they're more likely to default. It's very simple. Lending's always been very simple. The government likes to make it complicated, but it's not that complicated. We lend to good borrowers with experience, liquidity, and with their own money in the loan, and they pay. We've had no foreclosures. We've never lost $1 on a single loan because we make good loans with a lot of equity investment. This also does a lot of good in neighborhoods. We improve neighborhoods. We clean up the ugly ducklings in the neighborhood. We drive local economies, provide jobs. No surprise, the construction industry stimulates the overall economy. So why invest in this fund? Number 1 is liquidity. So unlike the previous fund, you can invest in this fund and redeem your investment with just 90 days notice. No long-term commitment. You get in, for some reason you need to take your money out for good reason or bad reason. you need your money out, 90-day notice. We've done redemptions in days. Literally, we've done it in 24 hours before. So we're highly liquid. We can redeem you very quickly. Number 2 is consistent returns. So this fund distributes out monthly. We have a 10% preferred return. That means you earn 10% annualized return before we earn anything, with an overall return target of at least 11% annual return net to you, as you'll see in a moment. So double-digit returns. We mitigate risk through quality borrowers, low loan-to-value, significant equity, and short-term loans. And these guys says first time flipping a home. So we're lending to experienced guys. We're lending to people who are doing this for full-time, often guys who are buying 20, 30, 40. We actually have a borrower who's buying 700 houses a year, to experienced professional investors. So here's the overview on the fund. So you invest and you commit for 1 year with 90 days notice, or less if you need it sooner. We pay you a 10% annualized preferred return monthly before we earn anything. And then you continue to earn 80% of all profits above and beyond that 10%. The goal is to generate at least 11% net to you. Historically, in one of the 2 funds we do this in, we're at 15% net to investors over the past 4 years. The other fund that we're doing this in is historically just under 13% net to investors, with liquidity and monthly distributions. So consistent double-digit returns. You can invest through your IRAs, just like all of our funds, but this is a great strategy that you can avoid tax while you're earning double-digit returns. It's a pretty great formula. And then this is an evergreen fund, so meaning we're going to keep this fund open indefinitely, but investors can come in and out as you would like to. Here's a track record of our fund. Actually, older versions here as well. These are the returns month by month by month. Our worst month was 12.33%. Our best month was 20.48%. Most months, 13, 14, 15, 16% annualized net returns paid, not just earned, but distributed to investors. In this fund and all of our funds, you can choose to reinvest your distributions, meaning let the money reinvest each month and continue to compound and grow. You can switch at any time. You can even do a combination. Where some investors say, hey, I want $2,500 a month distributed to me, and I want the rest to reinvest. You can do it however you would like in any of our funds. This fund, both of the funds we do here have audited financials as well. I know what you're thinking. Wow, right? So really great returns. We're lending on single-family homes throughout, mainly right now, Pennsylvania, New Jersey, and Florida, but throughout the East Coast. Low loan-to-values, good, nice homes in average neighborhoods. Average loans about $200,000. Our loans are scattered all over, so 16% in Lehigh Valley, where we're from, 34% right now in New Jersey, 17% in Philadelphia, Delaware Valley area, 23% here in Florida, and then a few percent in some other places. 70% of our loans are on single-family homes, 22 to 4 units, so 2 unit, a 3 unit, a 4 unit. Only 3% are on what we consider a commercial property, something with more than 4 units or a retail or an office to it. So mostly it's housing. In addition, in our income and growth, or actually, let me detour a second. So the third option you can do, and this is we're doing 2 things with all of the money that we invest. One is we're buying apartment complexes. 2 is we're lending money to real estate investors. The third way, though, you could participate in those strategies is you could lend money to the funds that we just talked about, or to DLP entities. That's the private notes. These are the fixed returns. This is how we started 10 years ago, where you earn a fixed return. Out of everything we do, this is the lowest risk. You get diversification, asset class, and mix of both properties that we own as well as loans that we own. You can commit for 1 year, 3 years, or 5 years. I know this is hard to read, but this is in your brochure as well. And based on the amount of money you choose to invest and the amount of time you choose to commit, you earn a 6.5% to a 10% fixed return. That's if you take the distributions each and every month. If you would like, you can choose to have your returns compound. And the compounded returns end up being 6.7 to about 10.5 if you're having the returns compound each month. Again, you can switch at any time, do a mix of both. So fixed returns, very low risk in the terms of very low loan to values. Typically for these notes, you're at the equivalent of a 20-25% loan to value on the underlying property. So I know it felt like a lot of information, felt like a hit in the face here with a whole bunch of information, but I want to kind of move through it somewhat quickly. What I'm going to do now is open it up to questions. So I'll walk around, answer questions you might have. Please, I encourage you to ask questions. Almost always, if you have a question, there's 5 other people with a very similar question. So I'll be coming around, and then as soon as we get finished with questions, we're going to do a quick raffle for a $100 gift card as well. But first, let's go ahead and answer questions. No, that's not my son. Good question.
If you invest in a fund that owns houses, how can you take a real estate deduction for depreciation since you don't actually own the house?
Great question. So in the first strategy we talked about, which is called the DLP Equity Fund II, that's the fund that owns these apartment complexes. You will be a limited partner in that fund, meaning you will receive a K-1 statement as a partner. You will receive your percentage of the depreciation based upon the amount of capital you have in that fund. So you can receive as a partner, and just like if you and your brother went out and bought a property and there were 2 of you as partners, you would each get to split that depreciation benefit. Same thing here, just a larger structure with more partners.
So you become a partner just by buying into a fund?
Yes, yep, you're actually signing into a partnership agreement, into an LLC is basically what it is. So, and short, just touch on that a little bit more with depreciation. So if we distribute to you 8 or 9% annual returns through cash flow, on average, you're going to receive about 9% of the 9%. We can pay you up to 9% returns that'll be pretty much completely deferred from tax through depreciation on average, and that's based on us having 1/3 of the capital being equity, 2/3 of the capital being debt. It works out to be basically for every dollar that gets invested in real estate, you get about 3% a year in depreciation, a little more than that, but about 3%. So if we use some leverage, you end up with 3 times that, which ends up being about 9% a year. So if we knock it out the park and we generate to you 11 or 12% cash flow, you'll pay a little tax. If we end up with 8, 9%, pretty much all of those returns. So if you invested $250,000 and we paid out $20,000 in distributions to you, that's 8%. Likely all 20,000 of that is going to be deferred from tax to depreciation. Now it's not, you will have tax when we sell everything, but you'll be at long-term capital gains. And then also we will likely have a way that you'll be able to continue to defer tax and roll your investment into another structure if you choose to at the end of this fund as well, kind of like a 1031 exchange. Follow-up question?
Sorry, follow up. If you become a partner rather, do you also assume liability?
No. So no investors in this fund assume any liability for the properties. You're not personally guaranteeing any loan. You're not personally involved if you have a slip and fall incident. It's a complete limited partnership. So you will have no liability, I can promise you. We have many attorneys invested in our funds, and many who had that attorney. You'll be very comfortable with the liability structure in these funds. Good question.
Are you worried about the changes in the tax laws that are being contemplated in Washington?
Great question. I wish I could know what they were going to be. We're all kind of guessing. I've actually had the privilege of sitting down with Trump's tax consultants twice, once before the election and once after. I'm in a group called Tiger 21, and we get some pretty unique access to things like that. And they're guessing. They wrote the plan. They don't know what's going to actually get through. What I can tell you is, we all know this, is Trump is pro real estate. He still owns a lot of real estate. A lot of the things that he talks about would be great. The last I heard is the expectation for long-term gains is that it'll end up being half of your marginal tax bracket. So, if you're at 32% bracket, we got 16%, but it keeps changing. People say one of the things going around that would be amazing is there's talk about being able to fully depreciate a property in year 1, which would be pretty astounding in this business. We could wipe out all of our gains every year just buying 2 properties. So there's a lot of interesting things. I think overall he's pro-business, and I think that the tax will decrease. but nobody knows. Nobody knows, 8 years from now what it's going to be. So whatever happens right now could be reversed in 4 years from now, as we all know. So nobody really knows. But overall, like most business owners, I think right now, generally optimistic that good things are going to happen, but we're all kind of guessing at this point. Great question. You follow that? Excellent. Any other questions?
Is there a cost to invest?
So no. So in all of our funds, when we talk about all these returns, we show whether it's the 7 to 10% fixed returns or the 11% plus returns in the lending fund. All of the returns are net returns. They're absolute returns, meaning there's not a nickel, a penny, an expense, anything that comes out of it. There's no management fees. There's nothing that will be deducted from those returns that you'll ever see come out of it. All the way down to if you invest through your IRA, we'll pay your IRA fees for you. We'll pay your annual account fee, we'll pay your transfer fees. All the returns with us are absolute returns, net to you, nothing that comes out of it.
If you invest and you have to get out of it prior to whatever the year you planted, are you getting 100% of your original investment, or do you get any percentage over that?
Great question. So if you had to redeem out of your investment early, what would happen? Would there be penalties to get all your money back? So we had 3 different strategies we talked about. So I'm going to talk about it from last to first. So the last one, the fixed return option. You came in, you committed for 5 years, and 6 months in, you say, hey, whatever happened, my son didn't pay his income taxes, speaking of tax, and I need to bail him out. I need to take my money out to pay off these taxes. We had that situation happen not too long ago. We'll redeem all of your money to you. We don't charge a fee, a penalty. You'll get all of your money back. We work strictly on the honor system there. We ask people, if you're going to go in for the 5-year note, plan to be in it for 5 years. Don't do it to get the higher rate when you expect you're going to need your money back in a year. But just the honor system, we've never charged a fee, a penalty, or anything. In the income and growth fund and the lending fund, the ones with the 11% fixed return where we're making loans, those funds have a 90-day redemption clause, but we can redeem you out much faster. You may think, well, how can you really do that? 40% of all of our loans pay off every quarter. Every 90 days, 40% of all of our entire portfolio goes to cash. Every single 90 days. So we have loans paying off every single week. We're highly liquid in nature. Again, we've done it in a day. We've done it 24 hours. This past tax deadline, whatever it was, this year, the 17th or something. I got 2 calls 2 days before the deadline saying, hey, Don, I got good news and bad news. Good news is I made a lot of money. Bad news, I need some money quickly. And we liquidated money within 24 hours so they could get their money out to the IRS. There's no fees, no penalties. The first one I talked about, the Equity Fund II, that's the one with an 8 to 10-year investment commitment. If you need to get out sooner, there's a clause to do that. You'll keep all the returns that you received, so the 8-9% annual distributions, you'll keep all of those. You'll get all of your principal back, but you'll likely forego some to all of the long-term capital gains you would have received if you had stayed into the fund until the end. So you get all your money back plus an expected 8 to 9% annual return, again with no penalties, no fees. Great question. Okay.
You have a minimum deposit.
Minimum deposit. So in the last option we talked about, the fixed notes is a $100,000 minimum investment. I also should mention that the fixed notes, the last option we talked about, is the only option that we have available to accredited and non-accredited investors. The definition of an accredited investor is a Securities and Exchange Commission term. That means you have $1 million in total net worth, not including the home you live in, or a $200,000 annual income, one or the other. And if you're not sure if you meet that, we can gladly talk about it. So you can go into the notes whether you're accredited or not. The equity funds, the first fund and the second option we talked about, where you're investing as a limited partner, those have a $250,000 minimum. We can work on you with that. If you say, hey, right now I don't have that much available, we can work with you on that and come up with a plan. If you have to liquidate things, it's going to take you time. The actual legal minimum on those funds is $100,000. Great question. Any other questions here? You guys are welcome to eat your desserts. Don't have to wait for me here.
You talked about what's being built now is Class A for rental. Doesn't A turn into B and C over time? So won't you have competition someday?
Awesome question. So you said, you know, there's everything being built right now is Class A, so won't we have competition soon? Because typically Class A properties, once they become 10 or 20 years old, then there'll be a B Class A because they're not the newest, nicest, best properties anymore. The problem is right now is that the multifamily is such a strong business. There's so much money flooding into it. That's what normally would happen. But what's happening right now is there's so much money going into that. People are buying those properties built in 2003, 2005, and constantly putting more money into them, remodeling these apartments and the clubhouses that are only 7, 8, 9 years old to keep them competing with the brand new communities. So it's creating this large gap that in normal times, yes, that would happen. There's always an aging housing population, so things are always going through that natural progression. There's so much money. Most funds in this space that do what we do, that have investors like we do, their strategy is buying B-class properties, B-plus properties, and turning them into A's. Or buying properties that you consider an A-minus, maybe 7 years old, and putting more money into it to push up rents. So there's so much money flooding into apartments that's creating a big gap that should be happening exactly what you're saying, but it's not in most markets in the country. Great question.
What percentage of defaults have you had on the loans that you all have made to these flippers?
Great question. So what's our percentage of defaults? So right now we have our highest number of defaults. That's also because we have the highest number of loans because we're growing very quickly. So depends on what you look at default. So if you look at default as 30 days late, which most lenders don't, and we pay very close attention to 30 days late. Right now we have 5 or 6 borrowers who are 30 days late out of about 200 loans. Borrowers who are typical default will be considered 90 days behind. We have 3 borrowers right now who are 90 days behind. All 3 of those situations, we are very, very well secured. Example, one of the loans is about $450,000 loan. We have a first position mortgage on a $600,000 loan. We have a first position mortgage on 3 condos, each worth $100,000. And then we also have a second position loan on a hotel worth $12 million behind a $3 million first. So we can only pray that he gives us doesn't pay us. That's not our goal. We try to work with them, but we're so incredibly secure that you know, we have no worry of loss. So we've never lost money on a loan. We've gone through a number of workouts. Every one of our workouts, we've ended up in some sort of workout situation. We bought a few of the properties back. We've done that twice. We did one deed in lieu of foreclosure and put $8,000 in the property and put it on the market, sold it in a couple days. We've never lost money. If we did, we actually keep a loan loss reserve account. And you'll see this if you look at our balance sheets, our good savings. You see we set aside 2.5% of our outstanding balance in a loan loss reserve account. That's our money, not your money. So we're actually putting aside our own returns into a loan loss reserve account. And if we did have a loss, it would come out of our loan loss reserve account, which is actually our money, not yours. We've never had to use that account. We've never had a loss on a loan. But if we did, it'd be our money first before yours. You know, we haven't been close to that situation because of how low our loan to values are and how much cash that's invested. Not that it won't ever happen. Well, it couldn't happen. You know, crazy things can. But that's one of the benefits of having hundreds of loans. Is one loan isn't going to sway the returns much either. Great question. Other questions here?
I've got one question. Man, since I live in Jacksonville, I know real estate very well. This apartment complex you showed up here, what is that address, please? Do you know?
7400 Crane Avenue.
Crane's a new street or avenue.
It's kind of like I'm not an expert in every local Jacksonville's a big city, but northeast Jacksonville.
Yeah. Well, I had recently, I don't know what Trump's going to do with this, but I wish us all the best. But with Section D, you know, the housing situation, you know.
Section 8.
What is it?
Section 8 housing.
Section 8 or D, where let's say a mother with 4 children can go to the government and get a voucher, and they allow her $1,400 a month toward rent. Am I correct in that?
In Duval County?
Yeah, Duval County.
That's probably correct. Depends what utilities are included, and sometimes she has to pay for all
Well,
that.
she would have to pay that too, I understand. The condo own up there in about 19 buildings, people are calling all the time, wanting to rent from them.
Yeah.
But I have certain rules and regulations on who you rent to, and you just have to be so careful, no matter what category you rent anybody, and that's life. But I just have been concerned about, the way we're going now, and how we're gonna get there, and
Sure.
everything else, because over many of the years I've had some problems with some, like inviting some around business.
Sure.
But I just wondered where that was in Jacksonville, that's the main thing.
Yeah, we don't have a lot of Section 8, we're not against it. We actually have a community in Daytona Beach, actually, when I showed there. We bought the property at 56 apartments, 38 were on Section 8. And most of them have been there for years. And it's a great property. People are happy, they're older. We've had no issues. And the first of the month, we get, 75% of our rent comes in a direct deposit, and it's wonderful. We've produced 23, 24% cash-on-cash returns since the day we bought that property. It's been excellent. But as a whole, we have, I think, 4 or 5% of our portfolio is on some sort of voucher. So we have some of it, but as a whole, it's a small part of what we do. There's a lot of markets where you can get more rent from the government than a regular tenant would be willing to pay. So there's a lot of people who focus on that. We don't focus on it, but we're open to
Get direct
utilize
deposit, that's wonderful.
it's yes, direct deposit. That's another big thing is, we focus on having all of our tenants pay direct deposit. So we were up to about 90%, as of end of last year, and then we switched to accounting software, so we're having to re-put everybody back in. I think we're back up to about 75%. By the end of this quarter, we'll be back up about 98% of our tenants paying direct deposit, automatic ACH we pulled out of their account. And that has brought and we actually bought a property management company in Daytona Beach, and that's actually how Jeannie joined us last March. And when we bought that company, they were a property management company, been open for 28 years. A great owner, very knowledgeable. Anybody would say he's the best property manager around. They had a 10 to 12% delinquency rate when we bought them. They never really tracked it. Now, eventually, a lot of those tenants paid, but they had 10 to 12% delinquency. They're now at 1.86%. So about a 10% drop in about a year due to the changing up the way we screen tenants, as well as the way we handle getting them to pay automatically and more aggressive policies and so forth. So management's a big part of success in apartments. Great questions.
Yeah.
All right, well then I'll let everybody, please finish your desserts, feel free to have another drink, and I'll be one more question, and then I'll be walking around, as will Larry and the rest of our team, and I can answer any one-on-one questions with you you may have as well.
Now, with this kind of track record and this size, why don't you attract some of the big real estate mutual funds, billions of dollars? Why wouldn't they put that with you?
Great question. So there's a lot of different ways you can raise capital. One of the big ways that a lot of people in our business raise capital is through what's called broker-dealers. Some of you might have heard of them before, the typical Wall Street firms that many invest with. And they'll go out there and they'll raise you all the money you need really easily. Actually, the largest multifamily owner in Jacksonville he's going through some challenges. He raised, a couple $100 million through broker-dealers. Well, anyone take a guess what a broker-dealer gets paid to raise you capital? 5 to 7% commission. So I can't generate the kind of returns that I show you and pay 5 to 7% commissions. There's just not that much money to go around. So we never paid out any commission. We don't pay commissions. The way we focus on growing is working with registered investment advisors, fiduciary advisors, who are actually investing people just like your money. So they're coming to their clients, so your advisor coming to you and saying, hey, I have this great strategy, I fully evaluated them, I did all my due diligence, here's my due diligence report, I think we should allocate 10% of your money, 20% of your money to this fund and this fund. So you're still then about seeing our opportunities, you're still coming to our dinners, knowing what you're invested in, and we're building relationships with those investors. So we like the idea of building relationships with our investors that will last for a long time and also not paying out commissions. Why we don't go, we've had many opportunities for large fund of funds or very large firms who want to deploy $20 million, $50 million, or often what they say to us is, we want to provide you with all your equity. We want to be your exclusive equity source. But that also means that we're going to be basically running money for them. They're going to be in charge, and if all of a sudden in one of their other strategies something goes wrong as the market turns, and they need to pull money from us, it can greatly affect us. So we have no investor. We have investors with as much as about $5 or $6 million with us, but no investor has more than about 3% of our capital with us. So no one investor's life changing could throw off our business or affect any of the rest of our investors, because we have hundreds of investors, 220 investors now, and our money's spread for many people. So we like the diversification of it, the long-term relationships of face-to-face relationships. So nearly every investor who's invested with us, 95% of them have sat down with myself and or Larry and invested directly with us, and we really like that approach. Great question. All right, so I'll let everybody continue your drinks and your dessert, and I'll be around to answer any other questions. Thank you.
That's
All right, we have a quick raffle here, guys. Almost forgot. All right, so real quick, I apologize. I know I said we were done. So last couple things. Number one, if you're interested at all, just so you guys know, we didn't bring any paperwork to sign you up. Nobody's going to bring out their checkbooks. There's no hard sell at the end of this. This is it. But if you are interested, this is something that piqued your interest, to at least learn a little bit more about it, reach out to myself and or Larry. Both of our cell phone numbers are on our cards over there, and we'll sit down with you one-on-one and discuss what we do in context to your goals and what you're trying to accomplish, and see if it's a fit for you. So with that said, upcoming events, July 20th, we have a big event in Pennsylvania. We do our events in Pennsylvania. We have about 200 investors out at them. This event will be an informational dinner like this, plus a quarterly review dinner for all of our investors. We'll also stream that dinner live, so any investors who are with us can watch and hear all the quarterly updates. You're welcome to come up to Pennsylvania and join us as well. And our next dinner here will be sometime in August. We haven't finalized the date yet. Potentially here again, or we might do it in Palm Beach or somewhere a little different for the next one, but that'll be in August, and everybody who's here will certainly know about that. So raffle. So $100 gift card, American Express gift card. They already pulled the name out of the hat. It is Clint. Hey. All right, so again, drinks and your desserts, and I'll be around to talk to you with questions. Thank you.